Hi guys, and welcome to our podcast. Today we're going to talk about life insurance as an investment. How does it work? What are the potential benefits, as well as the investment risk? When it comes to life insurance policies, it's not only about protecting your life. Many experts recommend it as a low-risk investment, which offers guaranteed death benefit. In this article, we will be looking at the advantages and disadvantages of investing in life insurance. How does life insurance work? The idea of life insurance is to provide financial support against the untimely death of the insured. They, on the other hand, must pay premiums so that the policy remains active. There are two main types of life insurance. The first type is term life insurance. As its name suggests, this cover offers protection against death of the insured for a certain period of time, called term. The term is usually between 10 and 30 years. Usually they're the cheaper option. Example: Emma has a $200,000 20-year term policy. Within this period, she passes away and her family receives $200,000 as a death benefit. If she dies after the 20 years expire, the family will get nothing. The second type is known as a permanent life insurance. The name indicates that this type of policy offers a lifetime protection against early death. Some of them could even offer insurance after the age of 100 up to 120. There are different types of permanent policies: life, universal life, and variable life insurance. Not only do they provide a person with a longer protection, but also have a savings component. It can be used as an investment opportunity. There are quite a few benefits of investing in life coverage. The most important, naturally, is the protection it offers against premature death. The death benefit distributed to the family can help them overcome any emotional as well as debt issues. Let's take a look in detail. First, it protects your family. The death of a loved one is a most terrible event. Often we can have to deal with situations like this. With life insurance, things can be much easier and can help you overcome this. Most people take out life insurance policy with the idea of securing their families in case of their demise. Indeed, the death benefit is secured and will relieve your family until they manage to overcome this difficult situation. Certainly, having bought life insurance will guarantee you more peaceful days and assurance that whatever happens tomorrow, your family will be protected. Also, it's clear the financial mess. In many cases, when a person passes away, the family has problems repaying their debts. You know that they inherit both good and bad assets. Fortunately, life insurance policies offer a protection against unpaid debts. The policy will cover all unpaid obligations. This includes personal loans, credit cards, and others. Life insurance can also make a profit for you. Permanent life insurance usually offers something referred to as a savings account, accumulation of cash value. This account, of course, has an interest rate. The earlier you purchase a policy, the better for you and the more returns it will bring. You can use the cash value to pay for missed payments in order to keep your policy active. You can also take out loans from it, covering different expenses and in times of pressing needs. Keep in mind that you can also use the cash value to invest in stock, bonds, or other markets. Cope with retirement is another benefit of this investment. When people retire, their income decreases significantly. This could be a serious problem at first when you have to adjust your financial management. By having life insurance, in particular permanent life policy, you can rely on additional money. This money comes from the interest your cash value has generated. It's like a savings account with a life insurance policy. When selecting a life insurance, there are so many different options to choose from. There are term policies, which offer a coverage for a fixed period of time and lower premiums. Permanent life policies, on the other hand, offer an investment tool, a savings account, as well as a lifetime coverage. The diversity is incredible, and there is always something that can suit your needs. But, as we all know, there's no free lunch. Every single investment has its good and bad sides. Having discussed the benefits, now let's see some of the negative aspects that go with life insurance. If you want to take advantage of the investment opportunity, you have to purchase a permanent life insurance. Only they offer customers the chance of a cash value accumulation. Therefore, the premiums are much higher, sometimes 10 times bigger. In addition, there are plenty of fees and charges that you have to pay. Unfortunately, a big part of the price goes to cover the fees, for example, administration costs. Let's not forget the commission you owe the person who sold you the policy. If you want to take out a loan from your cash value, you need to pay a cash surrender fee up to 10% alongside an interest rate. Besides the fees, there is uncertain and negative returns. Insurance companies talk customers into buying life policies by promising certain and usually high returns, which many companies promise to be higher than most savings accounts. Even though often policies go with a guaranteed minimum interest, the real return is not as high as that. Why? Well, it's very simple. There are many fees and charges imposed on your account. After they are deducted, The return is far less than the guaranteed interest rate, let alone the promised one. What's more, these promised returns will happen only if you wait for a certain period of time before taking money out, say 20 years. One more thing on the downside is that, especially during the first years of the term, the chances are high that your returns will be negative. This is because often the fees and charges exceed the interest your cash value can generate. Another pitfall is the lack of flexibility of the investment. Unfortunately, life insurance policies do not offer much flexibility. Life is not static. Sometimes the more you predict, the fewer things will happen the way you expected. Can you predict an unfortunate event? A disease or an accident? No, but you can be ready for this. Having an individual retirement account, IRA, or a 401k gives you the freedom to reduce the amount you pay in case you face financial problems. This will not affect your account, and the money in it will still generate interest over time. However, life insurance does not offer you that. If you miss a payment, the money will be taken out of your cash account, if it's a permanent life insurance. Of course, this will result in the decrease in the cash value. If there is not enough money in your account, or you have spent it on paying premiums, you might lose your policy. Don't you have the right to face financial difficulties and delay a payment or freeze payments for a while? Life insurance will not put up with this if you want your coverage to remain active until the end of the term. Last but not least, life insurance as an investment is not really tax deferred. Some life insurances boast with the fact that they offer tax deferred accounts. To some extent this is true. For example, whole life insurances gives you the opportunity to make tax-free withdrawals as well as to grow a tax-free savings account. The first thing is that though the growth of the cash value is exempt from taxes, the premiums you pay are not. Unlike health insurance premiums, life insurance ones are considered personal expenses. The IRS imposes taxes on personal expenses. What is a little tricky is that the withdrawals, for example, are tax-free, but they aren't actual distributions. In fact, to take money out, you have to borrow money from your cash value. You're the lender and the borrower at the same time, but you have to pay the interest rate to your policyholder. So the equation is easy. You don't pay taxes on these amounts of money, but you have to pay an interest rate because you have borrowed the money. Can you imagine the rate to be higher than the possible taxes you have to pay on withdrawals? It's quite possible. Another thing worth mentioning is that if you take out a lot of money, you might exhaust your cash value, which, as you already know, can lapse the policy. Bottom line, before investing in anything, you have to be completely sure what it is you want to achieve. High returns, stable income, or protection for your family. Only when you know what your expectations are can you choose whether to invest or not in life insurance policies. In case you decide to do so, learn more about the different types of life policies and choose the best one. They all have their charms as well as their potholes down the road. That's it for now. On our website you can find more posts and podcasts as well as calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you agree with life insurance as an investment? We would love to know your thoughts, so feel free to share them in the comments below.